Welcome, everyone. We're getting to the very end of day 3 of FI Ident Edition. Very excited. I'm joined today by 3 amazing investors to talk about GP stakes and secondaries. I have with me Maurizio Tamagnini from FSI, Jérôme de Bontin from Capricorn Investment Group, and Yalda Aoukar from Bracket Capital. Thank you so much for joining me.
Thank you for having us.
I think to set up the ground, let me start with you, Jérôme, on you've been doing this for 20 years. Would love for you to share a little bit more on what are GP stakes, why you started, and what are some of the deals that you do?
I'm happy to do so. I must confess, when I saw the title, I was a bit amused, thinking Wagyu must be something close to elite or special. Then I went to the dictionary and I realized that it's really the combination of a breed of stock between Japanese beef and mostly European one, going back 100 years. And that it's also the most expensive meat, which clearly is pretty far from the reason why Capricorn was formed and why we got into GP Stake. So if you bear with me for a few minutes, I need to do a little bit of storytelling as to where we come from. The firm Capricorn was founded in 2000 by a gentleman by the name of Jeff Skoll. Jeff was one of the 2 founders of eBay, and if you may recall, eBay went public in 1999, and a few years later, Jeff left at age 29 with about $5 billion of money that he was not prepared for. He decided to create a foundation, the Skoll Foundation, with the idea of giving this money back. He was certainly one of the first signatory of the Giving Pledge, with the idea that he would give those $5 billion back over the following 25 years. He also started a production company with the idea of storytelling and communicating to the world important information about topics that mattered to him, such as global warming, decarbonization, electrification, and so on. And thus was born Participant. You have probably seen many of our movies. The most recent one, the last 10 years, were, of course, the documentaries with Al Gore, but also movies like Lincoln, The Post, Spotlight, Bridges of Spy, Green Book, and so on. And at the very same time, Jeff and my partners asked themselves, since we're going to take 25 years to give this money back, what can we do that's meaningful? Why don't we create an investment firm? Thus was born Capricorn. Name Capricorn is fairly simple because Jeff was born in January. But the idea with Capricorn was to create an impact asset management company that would invest in things that others would not. And the idea was to find original technology that would take quite a long time to mature, but which in their own way could be transformative over time. And because they were all at Stanford, because they were all coming out of either physics or astrophysics, they decided to focus on venture. So the reputation of the firm really started with this notion that we had very patient risk capital to invest. And looking back at history, you would read that Capricorn was indeed one of the first investors in Tesla, was certainly one of the very first investors in SpaceX. And over time, we've made about 50 investments, which is not many if you consider it's been 25 years, in tech, in related industries that deal with decarbonization, global warming, and social progress. We also wanted to be in public equities. We also wanted to be in other asset class. So we started looking for other asset management companies to which we could allocate money. We were interested in plastic, water, ag and food, all those things that have become fashionable today. Where back in 2004, 2005, there were hardly anyone. I mean, people probably know of the water fund that Pictet launched in the mid-90s. The Pictet fund at that point had 100 million in assets. We had billions to deploy. And therefore, what did we do? We said, well, why don't we create new asset management companies? Why don't we fund startups? Why don't we find entrepreneurs who have the same interests as we do for the different topics that I mentioned, and we'll let them get off the ground. And indeed, we have During a good 15 years, I helped a number of iconic asset management companies start from a few millions to several billions. And this became a bigger business as the topics that we were investing in were becoming more and more popular. And eventually, we launched a few funds, so GP staking funds, whereby we raise money from ILPs, mostly institutional one, which we deployed in other asset management companies. Was not an easy task because whenever you talk GP stake, people think fund of fund.
Yeah.
And I can't tell you why, but that's what it is. So I spent a lot of time saying, no, it's private equity in one industry, which is the industry of asset management. And in the end, why are we so bullish on it and why do we continue pushing it? It's simply because global warming, climate change, decarbonization have become real themes. The trillions of dollars that are being trickled down to those sectors, and they have to go through asset management companies. So we look at now we do few startups, we'll do a few more, but we're looking at asset management companies that have between 50 million and 500 million that are on their first fund or second fund, that need to grow, open an office in the States or vice versa in Europe or in the Middle East. They need capital to grow their fund. So a typical schema for us is we'll put $2 to $10 million into the working capital of this entity. We'll put up to 100 million into the fund as an LP, typically in exchange for about 20% of the ownership. We want a minority stake. We want the entrepreneurs to stay entrepreneurs, and it's something we're going to continue to do.
And when you started, it was, let's say, only investing in the GPs that were starting new firms, right? And now it evolved to also investing in consolidated firms?
No, we did both. We did investing in what you call the GP, I mean, the legal structure of the firm, but they needed help in having a critical size in their funds. So as they started the business, if you go to market with 10 million in your first fund, it's going to be hard.
Yeah.
If you have 50 million or 100 and the stamp of approval of a company like Capricorn, it's a lot easier. So.
And you usually do both things. You invest in the GP and put a check as an LP
Most
as
of the
well
time
as
we
a
do
fund.
both, yeah.
Okay. Mauricio, let's go with you. Maybe tell us a little bit about yourself and FSI and your take on this concept of GP stakes, especially on established firms that I think you've done a couple of deals.
Thank you. I think my colleague on the right has said nicely the framework for what is really the name of the game right now in terms of GP stakes. The numbers that are being rumored are around 20 billion or something like that.
200 billion, yeah.
Yeah. Then from the announcement into the real numbers, I think there is a conversion ratio coming down, but still we're talking of a large phenomenon. FSI I founded it in 2011 together with a partner of mine. We both came from Merrill Lynch, where we have spent most of our career before. It's a continental European fund that focuses on capturing alpha. Before us, there was a group of speakers that was talking about mega funds, and now those are really dominating the market shares of fundraising and investing. We are what I would call a fairly sizable investor because we're the largest European country-focused growth fund. We have 3 billion under management, and we really do try to capture alpha via a simple formula, which is partnering, such as my colleague has said, with the entrepreneur. When we invest, we want the entrepreneur to stay and continue to work and not apply the leverage buyout formula. So we really provide growth equity into our companies. Checks that go from 100 to 250 million, so fairly sizable funds in established business models. 90% is technology, both digital and fintech and life science pharmaceuticals. So the two large mega trends in which continental Europe, if I can make a single point in terms of potential focus for you all, is a very interesting platform because you have a ratio of companies that have good products, good R&D, to how many of those have been opening up capital of really 1 to 10, what does it mean? That 90% of those companies are still 100% owned by the founding family, but they're good companies.
Yeah.
So we see great potential there. As you look into the specific of today, and you just asked me to comment, we have a GP that is 90% owned by the founders. And I would call, in again, continuing and qualifying to my predecessor colleague who just spoke, there are different qualities of Wagyu. I think that, I recently was in Japan, and depending on which municipality you go, there are different, qualities. I would qualify strategic GP investments are one thing, and financial GP investment are another kind of investment. We're more focused on the first one, i.e. strategic.
Can you explain the difference as well?
Well, the difference is mostly you do a strategic GP investment to look for, I think, three features. One, somebody that brings you specific know-how. For instance, our 10% investor is a large hyperscale type European player called Ion. So they provide to us really extremely focused knowledge in that sector.
Yeah.
So that I consider very accretive for us. Now, another important strategic determination in terms of a GP sale or a stake is succession. You need to plan out succession right in advance and do it in a way such that there is growth going on, but at the same time, you do not disincentivize through the sale of the GP stake
Exactly.
the current and the more junior partner. The third, very important.
Which I think that's one of the most controversial parts, right?
Very much so. And maybe I would end up with the issues that we see on issues, to be realistic, not issues on the financial stake deals. The third positive is diversification. We're currently discussing another potential GP situation with a large Asian, very diversified, long-term sovereign investor that would provide to a European, US, North American geared, that kind of global complementarity. So it is know-how, succession, and diversification as what I would call the strategic derivatives. When you have, and I'm getting to my conclusion, GP stakes being sold because you are really struggling to fundraise, and the numbers on the Darwinian process in terms of GP is phenomenal.
Yeah.
People say that 1/3 of the GPs will not be surviving that are currently now in business 5 years from now. When you do that just to financially maximize your value today versus tomorrow, and when you put constraints in the governance of the company and you put some sort of asymmetry between the GP investor and the other significant or non-significant LPs, because they're all the same, putting some entropy into the governance, then I would say still a very good, legitimate transaction, but something that probably is not FSI kind of Wagyu.
Yeah, and it kind of incentivizes like negative selection rather than really choosing the right ones. Given what you said, that potentially only a third of those, let's say, VCs will survive, do you also see consolidation of funds coming together and creating kind of a new GP under it?
Well, funny enough that, and for the audience, this was not an agreed question. The chair asked an interesting point. There is no narrative in terms of GP stakes being bought to drive consolidation.
Yeah.
In our industry, we are, almost all the GPs are driving funds that want to scale up. We're actually launching a scale up $1 billion fund, right? That will be a euro fund right now. But GP stakes are not used as a strategic tool to actually have the governance to drive that kind of consolidation. So it's actually something that maybe this panel can take as a signature to propose
Exactly.
as the next strategic objective.
The next step opportunity. That would be like a fancier Wagyu, I think.
Yeah, very little has been said, but maybe my colleagues have a different view.
I don't know, Jérôme, do you want to, are you seeing any of this?
We do. The market, I think, in the US is slightly different. It's fairly mature. There are three categories of GP stakers. You have the well-known companies like Blue Owl that will buy into well-established asset management companies that have already 10 billion plus, with founders who are about to retire. So they're really buying a business. They're buying the yield that comes with the business. And then you have those who only fund startups, the TPGs of the world, where they like to look at what we were doing 20 years ago, which we do a little less of. And then you have what we call this mid-market, where there's about 100 companies that we have identified that have between 50 million and a billion, say, that need money to grow. And that money will come either through GP stake investing or a combination of GP staking and investing into their fund. The main thing for us, it has to be tied to an environmental or social cause. Yeah. That's what we look at. I think the main red flag for us is if as soon as we start talking, the entrepreneurs are talking to us about exiting.
Red flag.
We believe in the entrepreneur. We want to bet on the jockey more than the horse. So that becomes for us the main criteria.
And what I see is another of the driver has been like, of course, companies are remaining private longer than they used to, right? So that is also driving GP stakes. Maybe, Yalda, we go to you on the other side, which is like secondaries. But first, can you share a little bit of who you are, the firm that you founded, and how you think more on the secondary market, because you guys are very active in that space?
Yes, absolutely. And typically I'm on a panel. I'm always one of the few female participants on it. So they start with female first. So there's a lot of pressure on me. So I'm actually quite relieved that you gave the stage to my male colleagues, and it got me to reflect a bit. I co-founded Bracket Capital about a decade ago. So we're the same age as FII. We'll turn 10 next year. And we focus on investing in private growth and late-stage technology companies. So I'm biased. I would say the premium Wagyu is actually in VC-led secondaries. And I'm actually a recipient of GP stakes transactions because very early on when we launched Bracket in 2016, we sold 10% of our GP to someone who took a chance on us, and apparently I have good storytelling skills, so they liked the story. And that allowed us very early on to go and hire best-in-class talent from the industry to come and work for us, as opposed to bootstrapping and then scaling as we go.
And maybe, can you go a little bit deeper on how you found that initial investor in your GP?
It was someone that was going to be quite strategic, coming in as an anchor into the fund, etc. So they participated
as an LP
with us
as well, I guess.
They came in as an LP, they came in as a GP in the fund, and they always say it was the best investment that they've ever made, because now it's clipping, a percentage of the carry that we manufacture on exits, and obviously they get a percentage of our management fees as well. They came in at a very low valuation, and you saw what happened with Industry Ventures. They just got valued at 100, at 7 billion. Well, they're 7 billion in AUM, but sold exactly to Goldman Sachs. So there's definitely traction happening in our industry. But very early on, we decided to focus on the secondaries market. And for us, the main driver was price arbitrage. So we were thinking, why would we pay over inflated primary prices and compete with giants and effectively take negative selection bias on the remains, when we can participate in the secondaries market at a fraction of the last institutional round. And then we realized there's actually a lot of structural issues in the VC industries as a result of these companies choosing to stay private for much longer. You have early employees that are incredibly frustrated because they're not able to monetize and participate in the growth of these giants. And then you have LPs who are incredibly frustrated as well because there's very little DPI in the portfolio that they're engaged in. If you look at the VC industry for the last decade, you have an IPO window that's practically closed. You have a very sluggish M&A market. You have employees at these megacorn companies that have 99% of their wealth tied to these companies, but they still get their engineering salary at the end of the month, and that's creating more frustration. You have early stage funds that have 70 to 80% of their NAV that's tied to one or two big winners, but they're not able to monetize it because, again, the IPO market is closed. And they have a fiduciary responsibility to generate DPI for their investors because they've now overextended their holding period into 12 to 15 years. And then you have the very frustrated LPs. So we decided that we participate in this market as liquidity provider of first recourse to early stage funds, but also to employees who want to capitalize on the scale of the company that they've worked for. And not only that, we manufacture liquidity within our own portfolio to maximize DPI. And the trend has really dramatically evolved in the last decade. So when we started doing VC secondaries back in 2016, it was really frowned upon. Like the market would look at us as if we weren't able to get into the primary, and as a result, we would be doing the secondary. And now this has dramatically changed. For us, it was a very strategic decision. It remains a very strategic decision. Funny enough, now that everyone is starting to do secondaries. We've pivoted to structured primaries, but that's maybe for another panel. But effectively now companies are realizing that if you want to retain, attract, and reward talent, you have to facilitate those share tenders for your employees. And that's becoming much more institutionalized. It's becoming much more democratized. Two big examples are SpaceX and Stripe that organize those every 6 months. Bracket Capital is an approved buyer. That's how we create relationships with C-suite. They rather go through us rather than go through a porous brokers market where there's information risk and risk of leakage. And we think that more companies will follow suit, generating those systems of share tenders for their employees and creating more volume in the secondaries market.
And what do you see in the difference between, of course, the shares that GPs already, that VCs already have, which are usually preferred, versus the shares from the employees that are common stock? Like, do you get different type of...
Look, the way that we think about it, we're investing in growth and late stage. If these companies are going to zero, it's going to go to zero. For us, we're indifferent if we're getting preferred or common. That's not the model that we're after. We're trading these as our perception is it's an anomaly that these companies are still private. The max 7 of ventures, it is what it is, and you're just trading them the same way that you would buy an NVIDIA or Amazon on the public market.
Exactly. Maurizio?
Wanted to maybe complement what my colleague just said on a couple of concepts that are inflated, but just give my experience regarding secondaries and GP-led, and the concept of data. The data models are providing phenomenal opportunities in terms of GP-led secondaries. We recently went through one, and everything is done through AI. That provides very good tightening of spreads, narrowing of times, and it's a phenomenal incentive for large anchor investors that come in early, realize they gain, and then they want to sort of rotate their capital. So there, the experience is wonderful. The second comment I wanted to make is on DPI, and maybe Chair, you want to take another...
Maurizio, you have to give me 1 second because with the announcement, I can't hear a thing. Okay, now, please continue.
The first comment was on secondary, we'll leave it there. There may be another proposal that this panel can make, in addition to the one in GP consolidating objective, is on DPI. Now, DPI is really demetric. It's gotten to a point, and so I would argue there are two kinds of DPI. There is the hard DPI, where you get your money back to your investor, and the investor can do whatever she or he wants. And then I would argue there is a soft DPI, which you give the money back to the investor, but you tell them, look, yes, I give you the money back, but a piece you got to put it on my continuation fund, another piece you got to park it somewhere else. That is a lower quality DPI. So soon enough, my view, in an industry that is going up to the roof, where you have 25% of the exits estimated being continuation funds,
Yeah.
where you're going from 4 years into close than 6 years globally in terms of holding period, I think the industry soon will focus on not just on DPI, which is definitely the only metric, the name of the game, but the quality of the hard DPI
Yeah.
versus the soft DPI. Something maybe to propose again to FII in terms of potential metrics, my chair.
Absolutely. And maybe, Jérôme, like, how do you think about continuation funds? Because Maurizio is right. Like, a lot of them are coming up, and that becomes like the exit. So,
Well, maybe I'll comment on what you said. Our apologies, you should have spoken first. And
Oh, no, not at all. As I said, it was relaxing for me. I just reflected on everything
I take
you guys said.
responsibility.
and two, I'm delighted to hear that your partner.
It's
came
joint apologies.
Yeah.
By the way.
in, the Italian and the French, they always have to.
To the
compete.
Lebanese, very.
But
very-
on the notion of what you were talking about, the GP staking offers extraordinary return that people don't necessarily understand. GP staking is not only about buying into private equity asset management companies. We take stakes into asset management companies that do fixed income, that do public equities, that do all sorts of things that generate yearly return, and a portion of that return goes back to the GP. So it's not a passive investment to the extent that the DPI builds up pretty rapidly. We don't invest in hedge fund, obviously. We don't take things with capital risk. We invest in things which we think are going to grow because of the business that they are in. And when you look at where do the returns come from for a GP stake investor, as I just said, you have the return from the underlying in which the asset manager is investing. Then you participate in the fees and the carry that the manager is generating. And eventually, as the asset grow and the value of the enterprise appreciate, you also benefit from that. So I think there's a far cry between GP staking investing and traditional private equity or venture, where indeed sometimes people complain that it takes forever to get some money back. And I will add to that, the question I get the most is, what about the exit? People want to know, will it be 5 years, 7 years, 10 years? So in the meantime, I said, well, understand, you're getting returns right away because you're getting the return of the investment plus the fees. And two, look at the thing that we've done. We made investments in 2005 in a company that had 50 million that now manages 50 billion. And we own a pretty large chunk of it. Why would you want to sell that? The success of GP staking is that as the asset grows, it really becomes an extraordinary annuity for the investor. For the entrepreneurs, we always give them an option to buy us out. So if they reach a certain level of asset, meet certain threshold, then they can certainly buy us out. And history tells you, if you're a successful asset management and you reach a certain threshold in terms of AUM, there'll be a strategic to buy you out.
that makes sense. We can't have a panel without talking about AI, especially in this FII. So I'm going to go back to Yalda. Like, how are you seeing AI automation accelerate the shift in making transactions more standardized in the secondary market?
I think AI is helping the secondaries market become the VC market. If you look at every other asset class in the world, from commodities to stamps to cars to public equities, real estate, etc., the secondaries market is always orders of magnitude the size of the primary market. It's only in venture where you see these walls of capital chasing primary rounds and the secondary markets being just a very small fraction of that. You have over $1.5 trillion of unrealized values that is now trapped in US VC-backed unicorns.
Yeah.
Whereas the secondaries market, I think in one of your notes I saw, is only the size of $200 billion,
200 billion, yeah.
compared to a public market that's in the $200 trillion and more. So that convergence is bound to happen. And the only reason that it hasn't happened yet is they haven't yet figured out a standardized contract. And if you look at private credit, that's a great example. It was a very analogous, relationship-driven asset class, and through the advent of standardized contracts, it was able to democratize, and now institutional and retail investors can participate. So the moment that AI, and I really think through tokenization, you're able to create fractionalized ownership in these private companies, then the floodgates will open, and you'll be able to democratize that entire asset class. And for me, it's not foreign that in a few years' time, I'll be out of business in 5 to 10 years, because you'll be able to buy your shares in Epic Game and Anduril and Stripe and XAI on your IBKR or eShares portfolios.
In talking about that, like I just had a very good friend who has this company in Miami called Securitize, and they've been doing secondary markets for a long time in tokenization, and they finally went public after 10 years at over $1 billion valuation. And it's more because, yes, money is being trapped in secondaries, and this is a way to give liquidity. Maurizio, how do you think about this?
Well, I agree on the great potential of AI. I will also launch myself into a parallel with AI, which I'm not the first one saying it, but generally speaking, I think the great revolution of AI is going to face, from a financial standpoint, what has happened in the early 19th century for the US railroad. Too many people are building the railroad. Too many people are building these LLMs, and there is no need for more than one large general LLM. So from a financial standpoint, I think we're going to get there. I hope that my colleague is not completely right in us going out of business, because I believe that, generally speaking, our business has a lot of combination of IQ, EQ, and DQ, decency quota, which is another concept of really doing stuff in a way such that you really drag with you parts of the society, part of the economy. So I hope that you're not completely right, otherwise we're all going to be out of business. Maybe one last comment, as you touched on data on valuation for our business, which we talked about.
Which is really important across the board.
Yeah. I generally think that valuation is very high in private equity, and the amount of inventory is phenomenally high. The data, for instance, from Bain's last report do show that. That said, and I live with a third concept in terms of GP, for us, valuation is not the key determinant in terms of valuation of our GP as I look for a partner. We even are thinking of something that will make your hair really go up, of having a primary GP injection. And therefore not even monetizing. And why? Because we're sitting on cash, because we're really truly believing that it's going to be a Darwinian process in the next 5 years. So we're building up cash together with potential currency as equity to consolidate the European specialist technology, healthcare, alpha market, in terms of us being there, hopefully maximizing our chance for the next 5 to 10 years.
But Yalda, for you, pricing discipline is super important. How do you think about this?
Yeah, I think it's very tempting to inherit your headline valuation and price to the last institutional round. At Bracket, we take a very, very conservative approach. We always mark to the worst of the last institutional round, a large secondaries block that would have traded at a large discount, our public market comps.
And do you have some of these companies doing secondary programs of buying themselves shares from the employees that you use as well as part of the valuation?
Yes, so we look at the combination. But again, what ends up happening is, I can give you an example. A company in our portfolio called Airtable, the last institutional round was at $11 billion.
We know Airtable.
You know Airtable. The secondaries market is trading it at a 70% discount. So we mark our book at a 70% discount, although it might surprise to the upside. But the lesson that we've learned in our industry is that it's always better to underpromise and over-deliver,
100%.
as opposed to misleading where the risk profile of these companies is actually sitting.
And we're running out of time, but I want to finish the panel with the same question that I asked my previous one, which is, what have you heard in the last 2 days that has blown your mind at FII? I don't know if either in a panel or because of a conversation passing through, but whoever wants to go first.
Nuclear fusion.
Nuclear fusion. Okay, that exactly,
good.
because now energy is a big topic, especially with
Absolutely.
computational.
It'll definitely be a field that we'll be taking a deep dive into.
Great. Jérôme?
It's more what I didn't hear. I was surprised that in the program and in the comments that were made, very little was said about space this year. It was such an important topic in the past.
That's so true. Jérôme? Maurizio?
Well, for me, I have to say, I've been coming to FII since the beginning. It's really how FII is the showcase of a country that in the last 5 years has really dramatically changed. So it's great to see this happening. I was in the desert on Sunday, and the Wi-Fi was working
Perfect.
definitely perfectly, not even comparing to the major European and US cities. So great tribute to the leadership.
That's so true. I come at least twice a year, and every time is like more impressive. Thank you so much for joining me, and thank you all of you.
Thank you.
But